All right, well, we can kick it off. I'll hand it over to you, Bill.
Thank you, Kelly. Can you hear me okay? A little feedback, maybe? All right. Well, hey, thanks everybody for sticking with us. I know it's been a fun couple of days, and you guys hearing a little something? Okay. All right. Anyway, we'll work through that. But yeah, it's great to have everybody here. We got to, I think we saved the best for last, and we have 3 different DSOs here with 3 different funding models. However, I think when we were talking on the discovery call, it seems like they have a lot of similarities too with the cultures they've created and the way they do a lot of different things. I think probably the one most recent event that has got everybody intrigued is the IPO in December, correct? That Park Dental Partners did. So we're going to learn all about the reason behind that and what that means to them and the industry as well. We have Align Dental Partners here, who has a minority private equity investor. And then we've got Bill Becknell here with Mortenson Dental, which is pretty unique in the industry, ESOP, and then Dr. Partner owners, correct? So those are the investors there, the ownership model there. So again, Bill Becknell, CEO of Mortenson Dental Partners. We have John McClure, who is the co-founder and chief development officer at Align Dental Partners. We have Dr. Chris Steele, who is the chief clinical officer and also president and a couple other titles at Park Dental Partners. And then we have Pete Swenson, who is the CEO of Park. So a little round of applause, and we thank them for sticking with I'm Bill Neumann. I'm with Group Dentistry now, so it's good to see everybody. And I'm going to be moderating the session, obviously. So I think what we'll do is we'll kick things off with some introductions. And you may have heard Bill. He's had actually 2 sessions, so probably got to know Mortenson a little bit, but if you happen to miss those sessions, just get a little bit of an overview about your background, Bill. Maybe a little bit about what you did before you got into dental, and then talk a little bit about Mortenson, and then we'll kind of get into the models, because that's what we really want to dig into.
Yeah, thanks, Bill. Bill Becknell, Mortenson Dental Partners CEO. Joined Mortenson in 2014 after spending 8 years in the architectural coatings business. I ran PPG's company-owned stores for North America. Started there in 2006. We had about 390 locations, grew it to a little shy of 900 before I joined Mortenson in 2014. Before that, spent 21 years in the grocery business, working for the Kroger company. Started out as a bagger in high school. Worked my way up through the ranks, was director of operations there before joining PPG. Mortenson Family Dental was started in 1979 by our founder, Dr. Wayne Mortenson, who just really had a belief about taking care of patients, being active in the community, and taking care of employees. And from that time period, as children became into dentistry, they started practicing under the brand Mortenson Family Dental. After a few years passed, and some of the kids' classmates began to join, some of Wayne's classmates began to join, and through many great networking events like this, began to build relationships with others in the profession, running multiple groups. And some of those groups began to join him at some point in time, and today we're in 10 states, 156 practices, and about $300 million in revenue. Great organization. It's an honor to be a part of it. We have a doctor ownership and an ESOP ownership structure, I think, is certainly important to note. So,
thanks, Bill. John?
Yeah, perfect. My name's John McClure. Is this what? Just John. Yeah. Okay, perfect. John McClure. I'm a co-founder and chief development officer for Align Dental. A little bit about myself. My entire professional career has been on the business side of dentistry. When I graduated college, I joined a consulting firm called the Levin Group, and I was there for about 9 years and did a lot of practice management-based consulting. Really got good at looking at dental offices and identifying organic growth opportunities, inefficiencies, and really kind of targets to run an ideal practice. Ended up leaving in 2014 and forming a large group practice in New York. We acquired 13 offices and built a fairly large surgical center that was in the middle of those practices, and we were able to capture a lot of oral surgery, endo, and perio cases. And then in 2016, we formed Aligned Dental as a consulting firm to work with group practices and emerging DSOs. And our consulting business scaled very, very quickly. In the last 10 years, I think we've supported over 1,000 dental office locations in a variety of capacities with strategic consulting and M&A and raising capital. We do operational consulting and clinical consulting. And while we were building the consulting business, we started to acquire dental practices, 1 or 2 or 3 per year, and just kind of slowly scaling the group. And then in 2023, we actually merged together 9 different group practices under one umbrella company, that's Aligned Dental, and created a little bit of a unique business model where we call it a group of groups. And so legally, we're structured like a traditional DSO, where each of the groups have their equity sitting at TopCo, or the holding company level. And then we integrate them through one combined back office platform in Florida. And really, it's more entrepreneurial nature, where our model is that each group grows and scales and continues to do their own M&A and add practices, and we measure the financial performance of each of the divisions. And then when we get to future liquidity events or recap events, their equity is kind of valued at kind of the group multiple, but whatever's being driven out of the group. And so we've scaled very quickly. Today we're 59 locations. We'll probably be about 100 by the end of 2026, and aspirations to keep growing from there.
And I think I'll just mention this before we move on to Park, is that I think Aligned Dental Partners is one of those mystery companies out there, because they do so much. And I have a question. So you started with the consulting clients.
Yeah.
And did some of those become practices that you've acquired and then brought into the DSO that you've created?
Correct. Those kind of the 8 other divisions were consulting clients that said, hey, we ran out of capital. You know, Bank of America is saying no after $5 million of debt. How do we go to kind of the next level? And they kind of participated in that merger. And then, like we brought in a private equity partner that bought about 1/3 of the business back in February of 2025.
So you still have consulting clients.
Correct.
And so they're owned by doctors probably.
Correct.
And then you've got this DSO now that you've created, this
Exactly.
group of groups.
Yep.
Yeah, great. Okay, and then of course, the big news really last year was, Park Dental. And so Park, I've known Park for quite a long time, and they've always been pretty quiet and conservative, kind of going along, growing. And then all of a sudden, there's this IPO, and we haven't had a dental group go public in quite a long time. We had Dental Corp in Canada that was public, and then they went private. We had, I think, Perfect Teeth years and years ago that was in New Mexico and Arizona that was publicly traded, and then they became part of Western Dental, now it's on Robo Health. And then they, even way back when, Dental Care Alliance was publicly traded. So I think it's been rare instances and nothing recently where you've had publicly traded dental group practice. So let's kind of kick things off a little bit about both your backgrounds, if you don't mind. And then, I think the big question is, why did you decide to go public when, a lot have gone, other ways? And, I think let's start off with that.
Sure. How about I just tee it off and sort of take off from there? Yeah, thanks, Bill. Pleasure to be up here with you guys, too. Respect both your organizations highly. One thing I also want to say is that if everybody's looking for sort of a boxing match up here, it's not going to happen, because we've got a clinical director group. Sivers is out there. Britt's, I think, probably already left from Mortenson. Eric's down there. So we know each other well, and we respect what each other do together and what we're trying to gain in terms of propelling dentistry forward. So boxing gloves off today, okay, guys? So Dr. Chris Steele, general dentist with the organization. Park Dental, we're part of Park Dental Partners along with dental specialists, combined forces. We've been together for, we've been around for 53 years, actually started by Pete's dad, another fellow. And the specialty group, I think, is now 28 years in, if I'm not mistaken. And so we've got this real nice symbiotic relationship with that. And in 2023, we joined forces with this new organization, of which now we've taken public. Pete can get into the specifics of that. So I'm a general dentist, practice a couple days a week still at my home location. I hear, you, Bill, as an example. I'm like, man, you got a history that goes on forever. I'm a lifer with Park Dental. I've been with the organization for now 35 years. and general practice, sort of working my way through the rounds. I feel it's a huge asset still seeing patients, being able to look at where dentistry is going right now, a lot of the technology changes, etc. And then I've got this role, as Bill mentioned, of being Chief Clinical Director for our general side, and then doing assorted duties on the board, etc. So looking forward to the conversation this afternoon, and Pete, I'll let you take over from here with the actual group definitions.
Okay, thanks, Dr. Steele. We work as a team, day in, day out, so having him up here as a partner in this is just a normal cadence for us. So I'm Pete Swenson. Dr. Steele mentioned that our group was founded in 1972. Two dentists, general dentists, came together. One was my father, Greg Swenson. The other was Dr. Brian Murn. They had been practicing independently for a while, covering each other's emergencies when they were out of town and helping each other out, and they formed one of the first, if not the first, group practice in Minnesota. And their participation, actually a shout out to AADGP, they were participating in this organization in the 70s. So long history. Happy to be here to support the AADGP today and this week. So for those that don't know Park Dental, we are a group that's over 200 dentists, approaching 220 now, 87 locations. We are primarily and very densely located in Minnesota and into Wisconsin. Just entered Arizona this past month and a half with a practice in Phoenix and one down in Tucson. We have, as Dr. Steele mentioned, we've been in the specialty business, all of the specialties. It represents about 25% of our revenue, similar to Mortenson. We've been in that business for 28 years, so really learning every day how to operate each specialty a little bit more efficiently, as well as the general dentistry. So huge amount of collaboration between our general dentists and specialists, and just really happy to be here on the panel and hope to learn from others on the panel here.
Great, thanks guys. So I guess we'll stick with you all. So on the investment side of things, so you were looking for capital infusion, right? So you got to that inflection point. And so there's different ways to go. And so you chose to go public. Now, my limited knowledge, even though I have a finance background, I haven't used it in a long time, but I've always heard that, there's some limitation. It's because of the paperwork that has to be filed, the challenges there, and the cost to become public. So what made you take that route? And just talk a little bit about that journey.
Sure. Not something that was done quickly. We spent a lot of time as an organization thinking about how to position ourselves for the next 50 years. Our intention is to continue to grow and do so nationally. And it was a multi-year discussion with our boards. You probably saw, Bill, you published an article in 2023. We went through a restructuring of our business to formally create a management company. Prior to that, we were just the professional associations grouped together. So prior to the IPO, which just occurred in December, we were all 100% doctor-owned. And after the IPO, we raised a small amount of capital, $20 million. Again, really just to position ourselves with access to the public markets so we can use that tool to grow over the next 50 years. So after the offering, the doctors and a few team members still hold 85% roughly of the stock. So, Dr. Steele, I don't know what else you'd add.
No,
the color there.
Yeah, I think you did a nice job describing it. And Bill, I think the biggest thing is, for us, and it was a multi-year process of deciding, and as Pete said it best, this is not a short-term decision. We really said, how do we position this group for the next 50 years? Not just for our careers, but for that next group that's graduating from dental school and everybody else. And we felt this is the one way we could position it with capital and everything else to be able to grow. Because we felt we've got a really nice model. And it's been very successful for us. And I think we share a lot of the same values on the stage in terms of how we approach patient care, elevate the doctor and leadership positions with the group. And I think after 5, 6, 7 years of discussions, we came up and said, this is our way.
I would say there are kind of three primary objectives as we sought that public offering. One was to create an enduring organization, one that could continue to persist and provide a great atmosphere for doctors and team members and patients to kind of thrive. Second was to unlock some shareholder value, but also not create a situation where the doctor's voice was not a continued central part of our model. And last was to preserve and strengthen our culture. We have a deep culture. I know Mortenson's been around a long time, just outstanding organization. Wanted to really strengthen that through this, and this wasn't an exit for us, it was really a strategy to position us for the next 50 years of growth.
Excellent. And then, and I think, you talked about, we hear a lot about clinical autonomy and, trying to protect that, especially, when you're doctor-owned, and, then you look for, people that maybe aren't clinicians, and then you worry about the influence that they may have. So, and that's where when we think about private equity. And so you went the minority route, so you're not majority private equity backed. And what was the decision behind, we want to go with private equity, but we want them to be minority shareholders?
Yeah, I think there was really a lot of thoughts that kind of came together in the ultimate decision that we made. Initially, when we started our process was in 2023, and the debt market was really bad. And so when we were looking at really high interest rates, and many of the group owners here experience this today, when you look at borrowing money, is to say, what is the cost of capital, and how do you do M&A and be able to kind of service debt and interest? And so when we were looking at a lot of just kind of the debt side of things, when you looked at the cost of capital and the warrants and things that a lot of these lenders put on the business, when we looked at the other end of the spectrum and said, hey, if we did an equity deal, we were going to land at almost the same spot. It allowed for a little bit of liquidity alignment with each of the doctor groups that came in. And then also they were able to bring in other forms of debt that were more scalable long-term for us. And so one of the things that helped is, we did not feel like we were at a point that made sense to go do a majority change of control deal. There's a lot of growth that we had not accomplished in the business. And so really saying, hey, we could give up some equity because we believe we're trading in better capital. There's a little bit of liquidity on the front end, but more about funding growth to get to the next level of the business.
That makes sense. On Mortenson's side of things, I don't know if anybody has ever had the opportunity years ago, and I always talk about this, maybe he'll bring it back, is Mortenson used to do a symposium called Scaling Up. And I remember, and I can't remember who it was that ran one of the courses, but it was all about the ESOP, creating the ESOP program, which I think is also relatively a heavy lift to kind of create that. So talk about the history of the ESOP program, because you had one of the slides earlier today, I think it was 33% is ESOP, and then the rest, 67%, is doctor partner owned?
That's correct, yes. So the ESOP was founded or started in 2005. So we actually last year celebrated our 20 years as an ESOP company. We are a minority ESOP, so they only own about a third, so kind of like your partner. An ESOP is a trust. It's an ERISA managed retirement vehicle that buys part of the company. It borrows money to buy part of the company. Over time, that debt inside the ESOP is paid down. The company makes contributions on behalf of the employees. Those contributions are used to buy shares of stock inside the trust in the employees' names. And then over a period of time, as the business continues to grow, the debt is paid down, future contributions are made, the value for those employees' accounts inside of the ESOP continues to grow. And so it's a pretty exciting model because our employees are just very invested in the outcome of the business, and certainly the good business outcome is great patient care. So having them connected to that in a very, very meaningful way is exciting. We don't talk about our team members, we talk about them as team members, and we talk about them as owners. We don't talk about them as employees because they're not. We run an annual strategic process every year, and it starts with a survey to our team members to say, what do you think we need to work on? What would make your job easier? And they care deeply about the company, and that's a power that is just fun to be a part of. So the other part of that is the 67% doctor ownership. I don't know if you want me to talk about that or not. But
Sure.
So A lot of groups, different practices, as they've joined us, they've rolled some of their equity in to become part of a shareholder of the company. We've done that with individual practices. We've done that with groups. We are an S Corp, so we are limited today to 100 slots, or owners, if you will. We have about 78 of those slots filled. There is some proposed regulation to move that to 250 slots. If you have any regulatory pull, please, pull one for the team. We'd love to see that go to 250. But our doctors are really passionate about our business and really the energy of our future growth. When we go to grow, we do not raise capital or do equity calls from them. We've got a credit facility. We think that debt is significantly cheaper than equity. And so we have a $160 million credit facility with a $40 million accordion. We have 3 great banking partners that we use, and we're 6 months into a 5-year credit agreement with them. And so that's kind of the energy and the capital for us of how we grow. We deploy that capital, we buy more practices, stock price goes up, doctors get happy, we make S distributions, makes doctors even more happy, and that's kind of how that works.
And for maybe people in the audience, if somebody was looking to maybe create an ESOP program, and how, what's the level, what's the investment of time and money to do something like that?
Well, it's not as hard as going public. I would not think, but I will tell you there's a lot of regulatory activity and complexity to it, a lot of management to it. You don't just start it up and leave it alone. It will not care for itself. We run forecasts and projections on our ESOP just like we do our business. So, what's the value of the ESOP going to be? What's the repurchase obligation going to be? How many people do we think are going to retire next year? What do we need to do to fund that? And lots of regulatory activity around ESOP, so you got to be careful. One of the nice things about it is our ESOP trustee votes 1/3 of the shares of stock. She is very much invested in our business. It's kind of like having an external board member in some ways. She's been an amazing partner for us as well. But it's another set of eyes on the business. And then we value the business every year. And our ESOP trustee does that through a third-party valuation firm, sets our stock price, and then our doctors who are outside the ESOP can buy and sell shares of stock on their own internal market that's just contained within inside of MDP.
And John, on the private equity side of things, as far as, even though it's minority shares that the private equity firm has, is there somebody that is on your board? Is there some, do you have that extra set of eyes, kind of like Bill has?
We do. We actually have 2 boards. We have the doctor board for all the practice equity, and they vote on all kind of clinical decisions and kind of governance for the way that the groups operate. And ultimately, they actually have to approve new groups joining Aligned. And so I think there's a lot of alignment for that to take place, but they have to make sure that they, that they're going to play well in the sandbox and they add value. And so we do try to have them all kind of collaborate together and not just work on an island. And then, we, on our board, because it was a minority deal, the structure's a little bit unique. We actually do control the board. We've kind of guaranteed returns to the private equity sponsor over a period of time, and that's how we can kind of maintain some of the control. But, their equity sits ahead of ours a little bit, and so that's the balance that works really well. And so there are doctors that are on our larger board, but they kind of govern a lot of the operating and clinical decisions that happen out in the field. So it's this good balance.
And so for, again, anybody in the audience that might be looking at PE as a possible option, whether it's now or down the road, what are some of the things to look out for? And, are there some minimums, like you have to have a certain amount of EBITDA, and, just any thoughts around that?
Yeah, I think there's a couple of things that come into play. Certainly there's going to be kind of a minimum check size that a sponsor is going to want to make. I lecture on this a lot, and I feel like once you start pushing $8 to $10 million of clinical EBITDA or kind of cash flow, we're a quicker path to get there through, trajectory and M&A activity. You're going to start to be attractive as you're in that lower middle market space. It doesn't mean that there's not going to be a sponsor at some point that will dip a little bit lower than that, but the expectation of a private equity firm coming into a business is that they're going to generate fairly quick returns and be able to exit the business in ideally 3 to 5 years with about a 20% IRR or maybe 3x their money over that period of time. And so they need to see that there's a scalable path when they step into the business, that there's organic growth and there's synergies, but more importantly that there's a management team that's going to be able to continue to work on the expansion of the platform, and that's what's really driving the valuation when they come in, not necessarily what they're paying for today, but what's the business going to look like over the next couple of years, and how do they truly kind of right-size their investment, if you will. And so I think it's really critical that if that's something that any of you have aspirations to go do, is that you're positioning your business for growth, and you don't have to necessarily achieve all of it today, but you have a scalable model, and ideally a differentiated model. Not just, we've talked a lot of similarities up here with the groups in terms of a lot of equity in the doctor's hands, and try to have clinical autonomy, and really with doctor participation and be education driven. I think those are kind of two of the must-haves in really any successful platform. Like that's kind of, like I don't think there's any successful DSO that does not have equity participation and does not really focus on the doctors first and view management as support. So I think if you put those two on the side and then you say, what else can we do that's unique, and like the ESOP or going public or a ton of regional density, like kind of understanding the value add, I think that's what's really critical to attracting the right investor.
Great points. On the publicly traded side of things, you have to disclose every 90 days now, right? So there's a report that comes out.
Quite a few filings, yes.
So talk a little bit about what are the numbers that we expect to see? I mean, we all probably are in the stock market to some degree, and a lot of us probably don't necessarily pay, a lot of attention to quarterly filings, especially if it's in a 401k. But I think there's going to be a lot of eyes, no pressure, on you all, because you're the only publicly traded company right now. So what numbers do we expect to see? Just like in general, no predictions on what you're going to do, but just
We're not going there, Bill.
Right, you can't do that, I know.
Bill, if I could,
That's how trading.
yeah, working our way around to what we can say that is probably limited. You all can read our S1. It's a public document, and a lot of appendixes attached. I think I wanted to make sure we touched on a really important aspect of how we structured our company in anticipation of taking it public, and Dr. Steele can help me with this. There are some in the room here, Billy mentioned, there were a wave of IPOs of dental practice management companies in the 90s. That's what they were called before they evolved to becoming dental service organizations and now dental support organizations. That wave in the 90s and early 2000s, they were, and somebody can fact check me on this, but I think they were all venture-backed roll-ups, and they were the original sort of national roll-up of existing dental groups. So the VCs needed to exit and monetize. Contrast that with what we have structured, which really is unique. And happy to spend as much time with you after the presentation here. Love to have you visit us if you care to do that up in Minnesota. Really thoughtfully hardwired into our governance, the professional voice of the doctors. So our doctors who are practicing in the business that meet certain criteria, including clinical care, quality of care levels that our doctors assess, along with other criteria, including ownership of a certain amount of shares in Park Dental Partners. They, as a group of clinicians, have the right to appoint 3 of our board members. We have a 7-person board. As a public company on any of the exchanges that you list on, we happen to be on the NASDAQ, that exchange requires you to have a majority independent board. So three directors appointed by the doctors. Think about that through the decades. We believe the best way to steer the organization, whatever the circumstances are in the decades to come, is to have those clinicians in your boardroom and connected back to the clinicians in the practice who are seeing patients. They won't be retired dentists that are participating in appointing board members. So really unique. And maybe you want to comment on that a little bit more, just
You framed it up.
very important element.
Yeah, you framed it up well, Pete. I think, reiterating what the two of you have also mentioned here, we look at it from the doctor's involvement, which Jen, you just appreciated the fact that you've got to have doctor leadership for success in, a dental group. And, we value that probably as our top thing along with ultimate patient care. But I think you look at, as Pete had mentioned, we've got two different avenues here. We've got the governance avenue, which we've got the doctor's ability and those that have a certain value of shares to be able to vote in 3 of our board members, which at that point will put us in a position where our doctors feel like they're being supported with the right folks at that Dental Partners board table. And then also we've got the operations, right? And as Pete mentioned when we got going here is that, I think we've got this dyad concept that we want to run through our organization where I'm working with Pete, or even driving back down to the practice level where it's the doctors working with the practice managers and everything in between. And I think that doctor allegiance is going to provide great benefits for us as we move forward. I think the one thing I also want to throw in, aside from the governance, we're running 50 of our doctors. We've got in general practice, we've got basically 160 doctors. And, the vast majority of 50 are involved in operations in some way or form, other than just simply doing general practice. So there's a heavy influence of doctors, both within our operations and, as Pete's mentioning, within our governance structure. And we feel that's going to propel us moving forward.
Yeah, and I wasn't asking for any insider information. I really just wanted to know what kind of numbers, as far as, do we see revenue, what are the things that sell?
I can share a little, we did, as part of our disclosures in the S1 and our investor roadshow, our intention here and the expectation we set for our own shareholders, including the institutional investors, is that we'll continue to grow both through inorganic means, affiliations, acquisition of practices, and organically through expansions, de novos. And we're looking to grow each of those categories, about 3 to 5% a year. Inorganic, 3 to 5% a year. Organic and inorganic. So 7 to 10% on average. We'll hopefully punch above that in certain years, but it's a range of growth that we've demonstrated again in the roadshow. We were, what did we say, 11 years of 8% compounded growth. So we didn't misalign expectations with what we've already been able to deliver, and we'll see what happens in the decades to come.
And I think you made an important point earlier. You were talking about like Ortho America and some of those groups that were
Orthodontic Centers of
America that were venture-backed, highly speculative models where you're the opposite. You're proven long-term cash flow, very, very predictable. So, it was a lot different, even what was publicly traded way back when in the 90s compared to the way it is now. So, yeah, totally different. And interesting, how kind of far things have come. Why don't we switch things up a little bit? So we talked a lot about, access to capital and getting it in different ways. Maybe we talk a little bit about how you're looking to deploy that capital in 2026. I think things have really changed. We see, obviously, the story, interest rates have gone up, right? And they're kind of coming back down a little bit. So there was this land grab, and people were buying up practices, and in some cases, buying practices they shouldn't have bought, and overpaying for them. And now we've got focuses on organic growth or smart growth or strategic growth, whatever you want to call it. So maybe spend a couple of minutes and start with you, Bill. Like 2026, you've got capital, you're going to deploy it strategically, and where's that going to go?
Yeah, so a couple of places. We kind of look at our capital deployment across 3 different growth channels. I would call it Project Care 1.0, 2.0, and 3.0. 1.0 is really organically in the practice. Oftentimes we'll be making equipment investments there, new technology investments, etc. Project Care 2.0 is taking existing practices and expanding those. So we'll punch a hole in the wall, move into adjacent space next to us, double the size of the practice, add some providers, and do those types of things. And then Project Care 3.0 really is looking for acquisitions and affiliations. And we'll deploy capital down all 3 of those channels in 2026. And that's kind of our plan going forward. Ideally, the acquisitions that come on, we have a pretty solid organic growth model that has driven about 8 or 9% growth for the last 3 years. And so once we acquire a practice, we kind of start them in the Project Care 1.0 and start working on some of those things to help them grow, rev cycle improvements, some technology and those types of things. And then once they get where they're busting at the seams in the practice, we try to expand them or move them. So the the changes continue. So it's very circular.
So organic growth, again, we hear about this all the time now, so what does that mean? Because it means a lot of different things. It means different things to probably different clinicians and certainly different groups. So is it, better treatment acceptance, more patients in the door, bringing specialty in, a combination of all the above?
It could be a combination of all the above. We really look at organic as within the walls, right? So we're not changing anything major about the practice. What can we do to grow the practice within the walls?
Okay. And John, with capital deployment, you had some pretty aggressive growth goals, right? Expanding, like doubling in size.
We'll probably try to add at least 40 office locations this year, so it'll be fairly substantial. I anticipate we'll probably deploy between $50 and $75 million of capital. It might be a little bit bigger. We'll see how some of the integration goes. Traditionally, our model is more chunky M&A growth, and so I would look at from the M&A side, we have these 9 divisions that exist, and we will likely bring on 3 or 4 new divisions this year. And those divisions could have anywhere from 5 to 20 practice locations each. And then what ends up happening in our model is each individual division is doing their own M&A. And so when we look at the pricing model and the capital needs, we're doing cheap M&A inside these divisions, where they're finding, we kind of call tuck-in practice locations, where, and you're very familiar with this in your market, but we might have that traditional retiring doctor that's willing to work 2-3 years, and we'll absorb that practice, or even do a chart sale, and integrate that kind of within that, in the respective market, and then at the same time, we work on kind of adding and expanding new divisions. And so when we look at our capital for 2026, we'll probably spend 1 to 2% of revenue on CapEx, and we're investing very heavily in IT right now and trying to make it a little bit more sophisticated platform. We are working on integrating new AI, and we do an enormous amount of doctor training. And so Dr. Sivers, who's my partner and Chief Clinical Officer for Align, spearheads a lot of the education and training. I think it's just 2 weeks ago, we had one of our larger practices in North Carolina. They brought 15 of the providers to do some very specific case acceptance training and some clinical training. And so we really prioritize a lot of that. And we also allow each of the divisions to dictate the amount of investment they want to make with their and our cash together, because they roll so much equity in the model. They're saying, hey, we're accumulating cash in the bank. Let's together go fund this initiative. And so I think we're in an investment-heavy period of time, but we are also seeing a lot of organic growth that I think in some ways outperforms the market. But the last thing I'll say is exactly like Bill mentioned, our tuck-in M&A, we see very, very significant organic growth in year 1 through rate improvement, reduction in cost of goods sold, and then just some process-related things. And so that's driving some of the performance in the organic growth across the global platform.
So 40 practice locations this year.
Yeah.
So it's pretty aggressive, I would say. So are these potential consulting clients you already have, like you've already got these targets, do you have regions that you're targeting? Like what's that strategy there?
Yeah, so if someone's in the same region, we would kind of merge them together, or they would work together in the sandbox. There's nothing that works in our model for having people compete with one another. Each of the partners operates like a partner, even though they have separate kind of measured economics in our overall model. We don't have specific regions. If I had a great partner in Montana that's a really good operator and is really good at attracting doctors, I would be very happy to go invest in that business. They roll a lot of equity, so they don't view it as a walk-away when they do a deal with us. So I'm a little bit agnostic to geographics. I think we'd want to make sure that we can solve for kind of the doctor problem, and that's going to be one of the pieces. But it's really good clinicians and owner-operators that's driving a lot of kind of the decision-making of where we want to go. And then as far as consulting clients, yeah, and it's funny because people look at our consulting business. We don't go to our clients and say, hey, roll in with us. It's they get to a spot where we've worked them so far in a process and they're saying, I either go at this on my own and try to go get my own capital or start to build out my own kind of more sophisticated support team? Or is it more natural that maybe you guys can step in a more significant capacity? And that's what's really been we just aim for alignment in all aspects of our business, which has been one of the keys to our success.
That's great. Yeah, how many times do you use align?
As many as possible. So, but if you guys want to start using that too, we'd be happy to time that.
So for park and capital deployment, so it seems like you do your IPO, and then we see all of a sudden you're in Arizona, right? So that was one way you deployed some of that capital. And that was kind of an interesting move, right? That you had never been in that state before. So I'd love to kind of understand, was it a great partner that you found there? And it's actually a very business-friendly state as well. So that's certainly another thing. But maybe talk a little bit about how you're thinking of deploying capital. And I'd love to find out how you ended up in Arizona.
Yes, well, it's a lot warmer than Minnesota. So, I would just start with organic growth. We have had decades and decades of just this continuous growth culture. So we're trying to get better each year in organizing the opportunities that each practice has for growth, whether that's, and I can have Dr. Steele talk a bit about that with the doctors. We're also looking at opportunities to add specialty. Again, similar to Mortenson, we've had that in our group for over 25 years, so those are great opportunities in addition to growing the general practice. And then de novos. So we've got a long history of deploying capital in that way, and honestly, it's a great way to grow. You extend your own culture. You can pick your timing for the most part. On the affiliations and acquisition side, I'd say we're looking for like-minded doctors who, when we're looking at buying a practice, we are looking at operating it as stewards for really in perpetuity. We're not looking at it as some aggregation and an exit. So that really is how we approach it, and having like-minded clinicians matched with our clinicians it's an essential. It's just a clash if it's not there. So maybe I'll have Dr. Steele talk a little bit about that.
Yeah, and I think to answer the question also, Bill, I would say that we're all dealing with it, right? Margin compression, and you're looking for anything organically within these practices. Sure, you can get the doctors to grow. You hire new doctors, and we're trying to do a better job of accelerating their growth by advocating for them, doing more intentional coaching these young doctors, and trying to allow that happen. But I think with the organic growth in itself, you've got to find any little spot within the practice. And I'll use a good example. I mean, let's face it, we're heading to a stage now where we've got more women dentists than male. And, young women are having children, which then leads us into situations where you have gaps of time, 3 months, or in Minnesota case, now 20 weeks, where they're out of the practice. And so that's lost revenue, right? So now we're starting to go through the process of saying, okay, one small component, but can we hire a float doctor that will then fill in these practice spots? So they're not necessarily assigned to a location. We've got the density within the Twin Cities that they can just move around and cover these spots. So I think, from an organic growth perspective, yes, that's it. And there's a million technologies out there right now. I think we're all using Overjet, is that correct? And, which is, I think, base or core level, looking at their overlays. But there's a lot of things that are coming down the path that I think are really going to help with organic growth, identifying areas within practices. But at the same time, we're going through it right now. They're all very expensive. And as we kind of laugh, everything's about $280 a month. $280, it just keeps compounding itself. And we've got to say, okay, when's enough? And but again, yeah, I think the organic growth, there's always opportunities, and we're always trying to plan too. I think now we're in this 3-year planning cycle where we're looking down the road, okay, is someone going to retire? What are we going to do about, year 2? When are we going to hire? And so everything is so much more intentional based on the fact of we just have to be that way now, so.
All right, so technology, I think it's pretty interesting. I want to talk about that a little deeper because, we've got a lot of vendors out there who are technology based. Everything's AI right now. I think we all have AI overload, and you hear that, and just your eyes gloss over. But there are some great solutions out there. I think it's trying to find the solution that's right for your practice, one that's built to last and built to scale, and the companies that can support it. But you mentioned something about de novos. And I didn't really ask you all, but what's the mix? How many? What is it? 60% de novo? Are you mostly de novos, and are you doing more acquisition? Kind of what's the strategy there?
I would say our growth has been expansions of existing practices, complemented by some de novos over the years. I think in Arizona, to address that, I think that's going to present more de novo opportunities for us, most likely going forward. As we've grown in Minnesota, where we have almost 10% market share, so those opportunities are fewer. They are still there, but it's a great way to grow if you can add to your team.
So I guess the challenge with the de novo is you need to have a doctor to put in there, though.
That's right.
So you're not acquiring anything, right? You've got to find the doctor, which can be a pretty big challenge.
Yeah, I think in today's world, it's also the team member support that you need around that doctor. So it's a headwind probably for all of us.
So is the idea that you acquire in a market, and then you kind of leverage their knowledge of the market, and then they're helping you look at, and so for Arizona, which is not an area you're probably super familiar with, in terms of Minnesota, are you kind of leveraging their knowledge to then help you expand?
Yeah, absolutely. Our goal is to land and expand, as they say. So you'll see us continue to build that density in our market. We have the advantage of density, as Dr. Steele mentioned, in the Twin Cities and in Minnesota broadly and into Wisconsin, where there's just a lot of synergies between recruiting and staffing that are meaningful when you have density.
And then what about Mortenson? Is it a mix of de novo and acquisition?
Yeah, de novos are more complementary. Saying we like to start with a base, be an acquisition, get it moving, and then split it into two practices. So you start with something. We will do de novos, but we're pretty strategic about those. We like to start with some kind of base.
Okay. Is there any time frame where you want to see a de novo profitable, or what's when you like as soon as possible? But what's realistic? Okay.
If we could predict which ones we're going to take off, we would build a lot more of them. Really, there's a lot that depends on the doctor you put into that practice and whether they're a practice builder, of course, the demographics around it. But we're still working on that formula.
Okay. And what about you, John? And is it mostly acquisition?
Predominantly acquisitions. I'd say maybe 3%, 4%. So we've done a couple of them. In consulting, I've helped clients do de novos quite a few times. And what Pete said, I completely second it. If you have an associate that's going to go into a de novo, especially a young associate without a lot of clinical skill set or experience, it's slow getting out of the gate. I think where I've seen it really successful is where you have a very well-versed clinician that has very good verbal skills, and then you need to couple a patient flow. And so if you're doing de novo, either you know how to market really, really well, and so you can get the office busy really, really fast, and you understand the new patient model, or you're putting it in an area that's next to an anchor tenant, like a Chipotle or a Publix or something, and the area is going to support that development really, really quickly. And so I think that naturally we've done less of them unless we think it's such a really good opportunity. What we have dabbled in is we kind of call renovos, where we'll say something, it was there, maybe the doctor died or they moved, and we can step into something where we don't have to put $500,000 into CapEx to set up the facility. You just sign a lease, and then maybe we have something synergistic in that market. So I would look at all of them, but I really try to say, what am I truly buying here? Because if it's going to cost me $1 million to set up this practice, and there's zero cash flow at day one, I can buy this practice that day one is kicking off $1 million with $200,000 of free cash flow. There's kind of that value proposition in trying to identify it. So I think you just need someone that really knows how to do them well in this space.
So let's get back on that technology subject, because I think this is always fascinating. And you all talked about using diagnostic AI, and you mentioned Overjet. So is that something that you've deployed recently, or have you been using it for a couple years and now it's kind of matured? Because that's really the first AI solution in dentistry, right? That kind of became mainstream 3-4 years ago. And there was early adopters then, and I think now it's become relatively mature. Everybody kind of sort of knows about it. So I guess we'll start with you, Bill. How long have you all been using diagnostic AI, and maybe talk about the results there?
Yeah, so we deployed Overjet AI probably 3 years ago in a pilot phase. I think it stayed in pilot for quite a while. We tried a couple different ways to put it into practices. and really optimize the use of it. And it's interesting, it's a great tool, but you have to integrate it into everything else because providers have a rhythm. They need to be moving from practice to practice or from op to op. And if you don't do those things right, it becomes a hindrance or an annoyance and it's not used, right? And so we spent some time getting that part right, testing and measuring. And we've seen a lot of benefit from it. We are now in a full rollout mode. By the end of Q1, early Q2, all of our GP practices will have it, pediatric shortly after that. But we see multiple values, and it really is different from provider to provider and practice to practice on the benefits of it. So some of the younger providers out of school, they absolutely love it for confirmation. Some of the older doctors, more seasoned, they don't feel like they need it, but at the same time, it's a nice way to say, hey, look, a confirmation, or maybe I didn't really notice that, and then maybe we need to talk about that too. So it's helping there, definitely helping with Curodont, recognition of an opportunity to apply Curodont and stop something before it comes full carries. And then really lastly is patient acceptance of treatment. I think that our patients trust their providers, but they also kind of like seeing that the computer says, I've got something going on here, so.
Yeah, you're almost gamifying it a little bit, right? So I think we're all used to kind of seeing things like that, and they use, I think, color so they can kind of see, red means bad, and it's like, okay, I can get that. John, how about you? I mean, what's the...
Yeah, I'll be brief. Almost identical. I think our rollout strategy is a little bit different. Just with our model, we'll have certain select odor doctor clinicians that really are more forward with technology that'll say, I want to go try that. And then our environment and our group it almost functions more like a study club, where we'll have different doctors that say, this is working really well for me, and they have the autonomy to go do that and then kind of learn from each other. And so I think for the offices that are doing it and have embraced it, have gotten great results. Again, Dr. Sippers, who I mentioned, he pilots a ton of technology across our platform, and so I think he's probably the first person to try it all to say, here's the pros and cons of rolling this stuff out. And so guinea pig's the wrong word. I think he's just open to change and open to exploring it and then saying, here's my feedback on, and a lot of times you can have great technology, but is the company ready to support it and to onboard offices? And so I think for us, it's always just trying to identify where's the technology versus the firm and, ready to roll out on our platform.
If you had anything to add.
I was just going to say, the amount of collaboration in our group around topics like this, it's fun to be around, it's intense, but I'm going to let Dr. Steele.
Yeah, basically the same thing, Bill, as you had mentioned. We started our piloting about 3 years ago, looking at the 3 different ones, the 3 big players, I guess, with Video and Overjet and also Pearl. And, we've sort of had ongoing sessions with everybody just to understand where the technology is really going. We've been satisfied with it. Our doctors are all using it since basically July of almost 2 years ago now. So it's been a while. And, there's a little bit of a learning curve. And, I was going to go the other way, Bill, or John, that was your response about, our older practitioners are fine using it, but you get your younger maverick dentists say, I don't need it, I just graduated from dental school, I can see everything. And, the reality is, it's a great tool for a doctor or even a hygienist, but at the same time, it's not foolproof. I mean, you've got to be able to reassess things all the time because what it shows is not perfect, but it's a nice tool, and more so, getting back to your point about Curodont, Bill, it's a great voice for the patients because they walk in, Bill, they see the red and they go, oh my God, I got red up there today, that's not good. And then meanwhile, you use a product like Curodont, which we're going to be starting to pilot again here. It's a great adjunctive thing, and we've got 2 other things here. We've been using Diddy AI doing our period charting, which has been great for the hygienists, right? They don't have to call somebody else in the room to help them out. And then, we're looking at the auto-scribe components right now, which I think all of us are looking at. Medicine's in it right now, saving time, whether it's nursing, physicians, et cetera, they can shut down, a lot of the record typing and texting, and ultimately, they're claiming to save an hour of everybody's day by going this direction. And it's kind of the Star Trek realm right now. It's out there, the last frontier. We're not there yet, but we're moving that direction.
Yes, I mean, I think there was a couple vendors that actually had the scribe, the AI scribe that were actually here today. Conversational AI is another solution out there. So we've got challenges, the front desk, and there's hear this number thrown around, that there's about 30% missed calls, so that's again missed opportunity. So how do you limit that? You would hope that there's no missed calls, but in reality it's not the case. So how do we kind of bring that number down? How do you, is it, you miss the call and it's a text, or is it a voice AI, or does it roll over to a call center, and all variations of this? And that seems like something that's also, is anybody using solutions like that, or looking at?
We are.
You are?
Yeah, so we have it first on the second, third ring, flipped to a live call center, and right now we're actually working on kind of pivoting that a little bit further to more of an AI call center where it can interact and schedule patients, and so we're just kind of beta testing that a little bit. I think the risk is you make it too easy on the front desk, where if they know there's something sitting behind it, and they're not motivated to necessarily answer the phone, you're paying for it twice. So I think a lot of the stuff too is just, it's measuring the correct amount of labor, how you engage with your team, but we are looking at that, just to say is what's the next level that we can put in place.
We use AI in our call center as well. We have an intelligent virtual assistant, answers, if the call goes to the practice, doesn't get answers, rolls, the assistant answers, the AI assistant tries to get the call to the right place, and we'll do some first or second level handling of the call, confirming appointments, those types of things.
Do you have any AI that you use that kind of monitors the call to make sure the right, questions were asked and kind of patient satisfaction?
We do go back and ask it to listen to a certain amount of calls and then provide feedback on that as well. Yeah.
We don't have that solution yet, but I would just say we definitely believe we've got to look at each workflow at the practice level and at what we call a resource group, shared services, and try to find the right solution. If I could jump in a time machine, go out 5 years and look at what solution worked, who were the leaders, that'd be awesome. But we can't, so we're trying to sort through all that and do it really thoughtfully, and it's hard work.
Right. I think there's also some, you kind of look at technology solutions. You've got, along the revenue cycle management, right? So you've got different solutions there that can kind of help
Right.
out. That tends to be a very clunky, people-heavy, process. And so I know there's anybody using any type of technologies to help with RCM.
Oh, absolutely. Yeah, a lot of automation opportunities there. We use dental robot. We've built a lot of internal systems to help with denials management, automatic posting, those types of things. So I've been with Mortenson for 11 years. When I got there, we were 80 practices. We had probably 80 people in insurance and collections and applying payments. I have about 40 now. We got 156 practices. So that's all been automation.
Okay. Any other?
We're in the process. That's one of our 2026 initiatives right now. Is just kind of reinventing kind of that whole rev cycle experience or journey from start to finish. And so exactly like you described, that's kind of we've identified as a major growth area where we can cut expense and just enhance the business.
Yeah, there's some great opportunities for us in that area. We've been working with EDI files for 30 years, so we've had some good efficiencies, but there's more we can do there.
We down about 5 minutes left. So maybe just real quickly, just some thoughts on maybe we talked a lot about 2026, but maybe you kind of look out 5 years. We've done your IPO, and you're going to do 40 practices this year, and so we kind of look five years out, and you've had several acquisitions this past year. So maybe if you kind of had hey, this is our 5-year plan. What does Park, Aligned, and Mortenson look like in 5 years?
Yeah, I think you could, as I was saying earlier, we're hoping to compound somewhere between 7 and 10% top line growth. You could equate that back to number of doctors, number of practices. We'll be in several more states, I hope, by that point in time. But again, taking that land and expand approach and really looking for the right like-minded clinicians that would fit well with our group.
What I would say is that you hear so many similarities. We're different life cycles of kind of size organizations, but focused on a lot of the same stuff. I think over the next 5 years, you're seeing DSOs consolidate into merge and come together. I think you're seeing some change in terms of interest of ownership from doctors that now want to be associates or participate with different equity. And so we're trying to map that, and we're maybe a little bit more M&A heavy at this point in our business. But our motto is our doctors roll an enormous amount of equity into it because they like the structure of it. So our goal is to try to recap the business every about 30 months, if possible. And so, we believe that with where we're tracking right now, we have a path to continue to do that for some time. And so for us, it's to kind of do it faster and chunkier and just kind of accelerate what we're working on.
Yeah, so we have a 5-year strategic plan to try and double our business, and think that's probably very realistic to do so. Look to continue to take care of our doctors and invest and also work down the organic growth path as well. Look forward to continuing to support the AADGP. I really appreciate what this group does and what the mission is about. I think it's important that we would all work to try to help fill the room here. There's a lot of value, I think, in this organization. I'm talking about Becknell in the 1970s, being part of this, so pretty inspirational, and look forward to continuing to learn from great groups like this, and appreciate being able to participate.
Yeah, this is a great conversation. I think the theme here is, regardless of, how you're built, it's really all about the doctor and supporting the doctor and making sure that, they play a role in, the ownership of the organization. Because we had seen some DSOs that weren't necessarily built that way. They buy the practice and the doctor had no ownership, and that never seems to work out really well. So, yeah, great. Do we have time for questions? Or hopefully we've got one. If not, I get it. But yeah, thanks. This was great. You got a question?
I actually have an Uber driver.
Is that who you were texting?
Yes, but I love to answer questions. Reach out via LinkedIn, Mortenson Dental Partners. Thank you so much for being here.